And now, financial advice and insight from a local company featured on Fox Business Television, in Forbes magazine, and local Best of the Springs winner 4 years in a row. Accelerated Wealth Radio with Bill Walton and Chris Abeyta.
What do the uber wealthy know about investing their money that you don't know? And what do they never do that you're probably doing right now that could be preventing you from growing your wealth? Hi, I'm Chris Abeyta from the Accelerated Wealth Show, and I'm sitting here today with retired Lieutenant Colonel Ryan Hall, one of our advisors here at Accelerated Wealth. And this is where you get retirement confidence in the midst of an uncertain world. Today, Ryan and I, we're sharing the 5 things that the most successful investors never do that help them incrementally grow their wealth. So these are the things that you don't want to do because they don't do them. The problem is you might be. So in this segment, we're going to talk about why the most successful investors, they don't just prepare their taxes every year. They have a strategy that helps them save thousands and thousands, if not hundreds of thousands of dollars in taxes every year. And so that's number 3, is successful investors, wealthy people. They don't just prepare their taxes. They have a plan that helps them save thousands of dollars in taxes both now and going forward for the rest of their lives.
Right. The truth is, taxes could be your biggest expense in retirement, regardless of what your income is.
Yeah.
And a lot of people don't understand taxes, and they don't think about it, and you need to. You need to incorporate that as part of your strategy. In fact, the more money you have stashed away in your various retirement accounts, the more at risk you are. Mm-hmm. If you don't have a tax-efficient investment strategy, it could cost you tens of thousands of dollars, possibly more. And Chris, let me give you a quick example. We had a client come in, right, early 60s, retired, multiple pensions, and over $1 million sitting inside of his IRA. And he was retired, life is good. And he had some expenses coming up with college and whatnot for his kids. And the thought was, hey, what should I do with my money? Hey, I'm going to pull out of my Roth accounts because that's tax-free and I don't want to take, you're making a face, that's good. You know where this is going. I'm going to pull from my Roths because that's tax-free income and I'm going to pay off and I'm not going to have a huge tax burden on this. And I'm going to save my IRAs, the pre-tax money, until when I have to pull it out when I hit 70 and a half. Well, we did the analysis, right? Sat around and looked through the numbers, and guess what happens? If he waits until 70, because he's got all these pensions he can't turn off, the required minimum distributions that he has to pull out of those IRAs at 70 and a half forces him into a higher tax bracket, and it just goes higher and higher every year as those R&Bs go up. By simply changing the strategy to say, hey, I'm going to handle the expenses now while we're in this low tax environment, he was able to pull a lot of money out of those IRAs at a much lower tax bracket and literally save hundreds of thousands of dollars over the course of his life that he would have just paid into taxes.
Amazing. Do you see this here? This is just one little thing that by sitting down with the right person that can look forward with your current situation and understand the current tax environment and the coming tax environment, this could save you literally tens of thousands, if not hundreds of thousands of dollars in unnecessary taxes. Now, if you're like me, you don't voluntarily want to pay more taxes, right? I mean, you pay your fair share, okay, because we live in a fantastic country. But if you can keep more of your money by simply looking at what's going on, wouldn't you want to do that?
Of course you would.
Absolutely. And so the key here is understanding what's going on and having a forward planning tax strategy when it comes to your retirement. Because if you've got a significant amount of money in IRAs, maybe you don't have that much in IRAs, but here's what we need to look at. Right now, we are in a low tax environment because of the Trump tax plan. Okay? Brackets have come down dramatically. Tax actual percentages have come down, and the brackets have expanded to allow you to take out a lot more money in lower tax brackets, and we call this a tax bracket sale. Taxes are on sale right now. So one of the things and the opportunities that we have are to actually look at this and see where you are to actually be able to take out possibly taxes now or take out money out of your IRAs now while we are actually in lower tax brackets. Because if you don't, if you wait, we know that in 2026, the Trump tax plan is going to expire. It'll sunset. And we're immediately going to jump into higher tax brackets. And if you wait to take the money out, you will be taking it out in a higher bracket and paying more tax on it.
Right. And we don't know what your situation is. Maybe you have lots of IRAs. Maybe you don't. But regardless of what your portfolio looks like, the key here is that you need to sit down and you need to have a proactive strategy to take a look and say, how can I be efficient with taxes, right? And this is not something that just happens. It's something that you have to design and something that you have to move forward with and act on.
It is, totally. And here's the facts. We know this. We know the Trump tax plan is going to expire in 2026 on January 1st.
Right.
Here's the other facts that we know that give us reason why taxes could not only go up then, but go up dramatically even more in the future. Okay. Democrats are already right now trying to remove the tax plan that Trump put in place, and they're trying to actually increase some of those taxes. Those are facts. They're working on those. Number two is we have a country with $21 trillion of debt right now. And we're adding another $1 trillion of it this year. So we know that at some point in time, that will have to be paid back. And the only way to do it, and this is from the Congressional Budget Office, is either for the government to spend less, which is really hard to imagine, or for them to increase taxes. So the writing is on the wall. Then we look at who's running for president in 2020. And we have on the Democratic side, we have Ocasio-Cortez, who wants to raise taxes to 70%. We have Kamala Harris, who's believing the same thing. And we have Bernie Sanders, who they're all looking at how can we make Medicare free for all, right? How can we make college free for all? What does that mean? It means we're going to have to tax more. And they can't just do it from the top 1%. There's not enough money. What typically happens is all those taxes come crashing down into where the majority of the wealth is, and it's in the middle class. So really the table is set on many standards that taxes are going to go up in the future.
So, Chris, this is good information. Why don't we spend the next period of time here talking about actual solutions to how to build a tax-efficient strategy moving forward?
Let's do that. So here's what you want to do. Number one is you want to look at what tax bracket are you in right now. Okay. You can grab your taxes. You can take a look at what your adjusted gross income was, and you can identify the taxes for 2018. Okay. Then number two is you want to take a look at what tax bracket are you going to be in retirement. Now, in order to do this, you've got to have an income plan that's going to add up all your pensions, your Social Security, how much money you're taking out of your IRAs, et cetera, and that's going to show you what your taxable income is.
Right.
From there, you want to identify what tax bracket are you going to be in. Then you want to compare that to what the tax brackets are going to revert back to in 2026. Okay, now once you know this, you basically can see, do you have a gap? Is there a threshold that you can reach up and begin to scoop money out of your IRAs in a lower tax bracket? So I know we're getting a little detailed here, but let me just give you the 24% bracket right now is kind of the sweet spot. And the reason is in 2026, when the brackets go back, the 24 bracket is going to turn into the 33 bracket. And the 28 bracket, and the 25 bracket. It spans all of those. So no matter where you're at, if you wait, you're going to be in potentially 3 much higher brackets than you are.
So let's take a kind of an example of what that would look like. So gentleman comes in. He does not have a lot of taxable income that comes in. And we looked at the numbers and said, hey, you know what? You're in the 12% tax bracket, which is fantastic.
Yeah.
Right? 12%. That didn't exist.
And here's why. The interesting thing is a lot of their money's coming in from rental properties, but they are actually depreciating those rental properties right now. So they are in a 12% tax bracket.
That is wonderful.
It's awesome. Yeah.
Awesome, right? So we took a look and said, you know what? You can take out up to almost $60,000 every year just to get up and still be in that tax bracket of 12% and not jump into the next one. Then we take a look and said, what are some holes in your financial plan, some areas that are uncovered that you have risks in, and how can we fill that using this strategy? You're going to have to pull the money out anyway once you hit 70 and a half. Let's pull it out now at a sale on your taxes, only pay 12% on it, and let's start bricking up those holes in the wall in your plan to make sure that you're covered.
Exactly. So here's some things that you can do with that. Number one, you can scoop that money out, and in this case at 12%, it might be at 22 or 24, whatever it is, it's on sale. Taxes are on sale now. Scoop that money out at a lower tax bracket on sale now, and then what's going to happen is you can actually convert that to a Roth.
Right.
So if you can do a Roth conversion while you're in a lower tax bracket, then you end up having money grow for the future that's going to be tax-free. You can use it for tax-free income. It'll also be inheritable tax-free to your heirs.
Right.
That's number one. Number two is you can look at another tax-free option. You can put it into what we call high cash value life insurance. And the reason it's high cash value, this is not your old-fashioned whole life that has a huge death benefit and very low cash growth. This has high cash immediately. In fact, up to 90% of what you put in can actually be available as cash in year one. Now, it's going to grow there tax deferred, so you won't be taxed on it. You can take it as a tax-free income in the future if you need it. Okay, it's accessible, it's liquid, it's there for long-term care, so you can actually use the death benefit to pay long-term care if you need it. And if you pass away, it'll be there for your spouse to replace any lost Social Security, any pensions, and then finally, you can use that tax death benefit, it's tax-free, to pay any of the tax on your IRAs that you pass on to your heirs.
That is so strategic. It's like killing 5 birds with one stone.
It really is. It's like hooking a bunch of fish on one hook. And it's very, very powerful. The other thing it'll do, I didn't mention, it will actually lower your required minimum distributions or eliminate your required minimum distributions in the future. So thanks for taking the time to listen to this. We really think there is a great potential for you to save a lot of money in taxes given the current environment and given your current situation. So we look forward to talking to you more about this in detail about your situation in our next visit.